Hello everyone, how's it going? And welcome back to today's video where we're going to be discussing the Schwab US Dividend ETF trading under the symbol SCHD. So SCHD does hold a very significant appeal amongst the retail investors due to the combination of high yield, low expense, and very reasonable fees. It provides a very diversified dividend portfolio in a single investment, which makes it a preferred choice in the market. So in recent years, the job market has become, very uncertain, and the inflation has greatly impacted our savings and economies around the world in countries that were for a very long period of time deflationary. So amidst these uncertainties, it's very important for us ourselves to improve our own financial future. And to achieve this, it's crucial to identify any sort of stable revenue streams that we can get in the market that can shield us from the market volatilities and also the inflation. Now, for many investors, SCHD has been considered as one such opportunity. It goes beyond being, say, just another dividend ETF, and it's often regarded as the symbol of a safe haven by both retail and institutional investors. Known for delivering stable and growing dividends, SCHD does stand out as one of the largest and most diversified dividend ETFs in the market, maintaining its popularity over time. So before today's video continues, if you like my content so far and also want to watch more stock analysis videos like this one, please check out my channel for more, as I keep all my the companies that I cover and all the ETFs that I cover in playlists so that you can stay on top of the latest developments. That being said, let's get started with today's video. Alright, so first of all, let's take a look at the price action of SCHD. So on a daily basis, SCHD reached a high of almost $78 at $77.98 and a low of $77.38. Over the past 5 days, it increased by about 2% compared to the previous chunk of 5 days, which is a relatively significant development for an ETF like this. Looking at the previous 30 days, it seems like SCHD has been able to pierce the ceiling of $77.33, although the percentage is relatively modest at around 1.2% increase. On a 6-month horizon, SCHD has been doing pretty well after bouncing back from a bottom back in November 2023. And ever since then, the ETF has been able to hover above the $75 level with an upward tendency on top of that. In terms of options, the key strike prices seem to be $77 and $78 levels, with a relatively split, a even split between the puts and the call options. It's like the stock is keeping its options open. Now, options are like a secret language in stock trading. They give you the right to buy or sell a stock at a set price. And we have to check the mix between the puts and the calls that can give us a clue about what the market believes where the price action will go next. So for those who are new to options trading, puts give you the right to sell at a specific price, and calls give you the right to buy at a specific price. If you see a lot of puts, it means that the market is generally speaking expecting a pullback or a decrease, whereas the calls, well, it's the opposite of that. People are expecting the stock to go higher. Now, when we look at the trading volume of SCHD, the recent volume is around 3.5 and 3.6 million shares, which is relatively consistent. And this means that SCHD is definitely one of the bigger dividend ETFs around. And it's definitely something to keep in mind, because it would mean that there is enough demand for any sort of trade size to remain liquid. And this is significant. So Schwab's SCHD is an ETF that has gained popularity amongst investors seeking reliable income streams. Launched by Charles Schwab, this ETF offers a convenient way for investors to access a pretty diversified portfolio of companies with pretty robust cash flows. A dividend ETF like SCHD essentially brings in together a collection of companies known for their very good dividend paying capacities and also reliable dividend paying histories. By investing in SCHDs, people like us, we effectively acquire shares in or participation, shall we say, in hundreds of companies in a single shot. So providing a pretty simplified approach to build a diversified investment portfolio. Instead of looking at hundreds of individual stocks, which you may still do so because either way, in any of the prospectus of most dividend ETFs, you can definitely go pick and choose which ones you want and which ones you would rather look elsewhere. But analyzing the financial reports and ratios, although it can be learned, it's not for everyone. And what SCHD does is that it kind of does this job for us. It scans through every single one of those holdings that it has and determines whether they want to include into the ETF. So one of the key advantages of SCHD really lies in the ability to yield a pretty decent profit yield for investors. The fund's emphasis on companies with consistent and growing ETF contributes to reliable income source for those seeking regular returns. The ETF's broad exposure to various sectors also ensures that it has a well-diversified investment spectrum, which will reduce the risk that's usually associated with individual stock picking. This approach is very healthy in the long run because although we may all have an idea of which sector is very popular right now and where you should pool in all your money, in the long run, things do tend to even out. And if stocks are manually bought, it's possible that those sectors will leave us to hold the bags when the tide folds back. And by removing our subjective mind from the investment decision, the investment will have a much higher chance of being smooth, even if the times are not very smooth at the moment. The safety in numbers is a very obvious advantage for SCHD as well, which includes a very substantial number of stocks. This diversity acts as a protective measure, helping to mitigate the impact of poor performance by any single companies. Investors do benefit from the resilience provided by a basket of stocks, making SCHD an attractive option for those prioritizing the stability in their investments. Comparing SCHD to the S&P 500 is also quite relevant, or at least more relevant than people think, because while both include many of the same companies, SCHD's focus on the dividend-paying stocks make it just a relatively safer option compared to the S&P. This emphasis on the income generation provides unique angles compared to the broader market, which can potentially appeal to investors seeking such a balance between growth and stability. And if we think about it, most of the companies included in the SCHD are large caps to begin with, and most of which are based in the US. So it's normal to see many of them also listed on the S&P 500. To an extent, we can say that SCHD is a relatively safer and more traditional version of the S&P 500 ETF, if that suits your needs. The price action of SCHD, other than, let's say, the individual fundamentals of, actually, we're going to be talking about the macroeconomic factors later on, but in addition to the specific performances of each and every one of its holdings, we can also explain this increase by the increased availability of capital allocated to equities over the past 15 years. Because as more investors recognize the importance of dividend-paying stocks in their portfolio, the demand for those ETFs have logically risen. We can also see that the fund's performance has also been influenced by the increased availability of printed money during the years of quantitative easing. So we can see that the yield of most assets around the world have definitely decreased, and it's probably for that reason. So for many, SCHD does serve as a stabilizing force in the investment portfolios, Its diversified nature, coupled with the safety in numbers approach, does help to smooth out the volatility. Now, it definitely stands out as a dividend ETF that can bring simplicity and diversification to investors. With its focus on companies with good cash flows and good a good track record that we can rely upon, SCHD offers a compelling option for those seeking stability and income in their investment portfolios. The fund's performance over the past 15 years, coupled with advantages compared to the S&P 500, does position SCHD as a pretty valuable tool for investors with specific financial objectives. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, having said all that, what is my opinion overall about SCHD? Should you, at the current moment, be buying this ETF, and how much you want to buy? That's a very good question. And although, if I want to play safe, I will always say it depends on your personal situation. In this case, I'm going to make an exception and say that SCHD, it never hurts to have some in your portfolio. The real question is how much you want to buy now, knowing that SCHD is approaching its historical highs and probably be piercing it by the time that you see this video. Personally, I do believe that SCHD will probably just keep rising unless there are market-wide corrections that are external to the reasons why those companies are individually suffering. In other words, these companies might having pretty good profits across the board, but it doesn't mean that the demand will always be there at the current level. In fact, in the short to medium term, I would say that it wouldn't be a surprise if you see that SCHD's price increases, and even significantly so. Why? Because we're kind of expecting decreases in central bank rates, and when that happens, equities will probably increase in their value across the board. Now, if that happens, we don't know for how long this kind of effect is going to last, but it's probably going to have a positive impact, at least in the short run. In the long run, personally, I would say that it's better to have a smooth purchase pattern instead of a going all in on day one kind of approach.